we're seeing, and people don't understand and are misinterpreting what Huffman has at Reddit. You can go get deals. You can find places with affinities to your area. And this is Zuckerberg's. Look, I think Zuckerberg has to be worried about these two. And by the way, you have to, you got to make a deal with the New York Times now. You got to there's a lot of things that you have to make deals with. When you're on these, the chat box, wow, sometimes they're sourcing from very dubious places, and they list where they're sourcing from, but they lack the big guns. They lack sourcing from the Journal, sourcing from the New York Times, and they tend to rely on, at least when it comes to stocks, outfits that you would never read.
Right.
And I think that that's a shame. But I like Reddit very much. I think Huffman is undervalued. They had a big short squeeze there, 18% short. It went up really big, and then the longs came out and buried Huffman. They buried him, and then the shorts came back.
Speaking of some media, Paramount nominating 3 new board directors, try to get this Skydance deal done. We didn't mention the Disney layoffs yesterday, Jim, which happened kind of throughout the entertainment divisions.
Again, see, I thought that might be AI, but what it really might be is, Hugh Johnson, ever since he came in as CFO, it's been remarkable. He's done a fantastic job. I understand Gorman's fully engaged trying to get a successor, expect nothing near term. But if you look at the Disney chart, so to speak, you'll see this is a comeback from when Hugh Johnson got in that is just fantastic. Now, he came over from PepsiCo, which is in bad need of a comeback. And if that Texas bill is signed, oh my, if you put this is what I was really worried with Constellation Brands. It was right to worry. Constellation Brands down big, over-indexed Hispanic, a lot of ICE guys hanging out at liquor stores.
Yeah.
Very bad. But when you get any sort of label, whether it be a skull and crossbones of beer, which would be very negative, or this is not fit for human consumption, there will be people who say, you know what, this is not good for me. And I think there will be people who always ignore it. Campbell's, when they did their analysis of snacks and why it was so bad, refused to go there. They refused to go to health. They refused to go to GOP-1. And I thought that was very ill-advised. They should have.
I mean, it took a while from between the time they put the Surgeon General's warning on cigarettes to the time tobacco really died.
Yeah, and during that period, those guys, they did they reshuffled the deck there with PMI.
Yeah.
But you can't have that label.
Right.
You can't have that label. Altria has been existing because the other guys have fallen apart and but that label is imagine if you're at a school and they have chips. You can't serve chips if they say that they're not fit for human consumption.
Look at where we rank in global health on obesity, diabetes, you name it. Finally, Jim, this Larry Fink op-ed in the Financial Times today talks about is it taking a second crack at globalization? Is that what he's trying to say?
Yes, in a new way. Globalization and localization. Economic nationalism isn't more convincing. He's saying, look, let's get people to invest. Helping more people become investors. This is the deeper shift I'm seeing in the economy. Governments are rethinking who markets are for. Remember, we've got a proposal in this, the most beautiful bill in history, Pulchritude, I'm calling it, the Pulchritude bill, about putting you're allowed to be able to have a saving account for a child, which I think is a really good idea. But this is a piece basically about, I think you want to be in those funds that he has about infrastructure.
Right.
I do. I mean, they're right now right now. I still think they're institutional. EU ahead of us here. EU. But every day I read something better about the EU. And when I was in Belgium, the left side nuke, right side 250 windmills. Left side, yes. Other side, there was no wind.
That's sometimes a problem.
Yeah,
yes.
That was Don Quixote needs wind.
Meantime, pretty mild open. Dow's essentially flat. S&P's up less than 5. Watch bonds. We did get a little relief in the long end with the 30-year back below 5. We'll get jolts and a little Fed speak today. Goolsbee, Cook, and Logan all between now and, say, 3:30 in the afternoon. 10-year 4.41. Stay with us.
Audio check. Is this thing working? Good morning, everyone. Anybody trading this morning? Here's my trades. All green for the day. Sorry about that. Show fill. So I went long here. Once it cleared this red move down, and that's pretty much it. Actually, taking a short here would have been nice too. This big tail, and just let's see how many points would that be in 45. That's 20, about 30 points. So 600 for every contract.
Vicious people.
Not too many retailers have actually increased guidance for the full year. Dollar General is one of them. Comps 2.4, Jim, that's double the forecast.
Yeah, that's good numbers, and everyone was looking for good numbers, and it didn't matter. They were great numbers.
You take a look at the gain of about 14.5%. We didn't do Ollie's either, down a little bit.
Yeah, I'm not going to bet against Ollie's because I'm a member of the Army.
Meantime, holding 59.40-ish. We'll get stopped trading with Jim in just a minute.
So like I was saying, so I took a long once it cleared this red. Actually, I should have gotten on this big bar. Maybe I should have gotten in once it cleared this. That would have been maybe better entry. But so the stop would have been below this bar. That's pretty much it. Anybody else trading? 335. That's good. I like when I see these all trades 100% winning, you know. Kind of tells you you're doing something right, right? So they gotta make me a morning tea. I had my tea yet.
to apply.
Let's get to Jim and stop trading.
Some stocks can't catch a break, and you keep thinking as they go down, do they ever get cheaper? Is there something wrong? Block, which is now XYZ, gains today because Evercore upgraded it. And I thought this was very significant because people feel that they're doing too many different things. They don't know what they're doing. And I think that they have decided to cut back excessive credit, which was good. I remember when Sarah Fryer was there, and that was the rap against them, was that they were willing to give people credit who shouldn't have. I thought this was an interesting level to buy a stock that has been thrown away. I really, really sometimes look at these stocks like a Roku, and I say, you know what, these have adherence, and if they catch a break, they're coiled springs. I think maybe Block could be a coiled spring.
It's been a complicated story, though, over time, right?
We do need them to, yes, not only is it complicated, but they make it complicated because, remember, it's Jack Dorsey.
Yes.
You talk to Amrita Ahuja when you do this, the CFO, and I've become quite used to her being completely straight. She was on in San Francisco, and she said, listen, the last 2 quarters, we didn't do them well, but we're going to get it right. Instead of the usual, which is like, these were very interesting quarters. Wall Street misunderstood them.
Right.
She wasn't going with that. She's a serious player. So I think that we should watch that one. Maybe it's got its time in the sun. I remember I'm an Affirm guy through and through. That's Max Levchin. Max is also someone who was kind of not a hail fellow, well, Matt. Hey, Max, what's shaking? No, I'm not. Nothing is shaking, Jim. What do you mean shaking?
Jim, we'll see you tonight.
All right, very
as
good.
we continue to chop through this week, awaiting jobs number on Friday. Jolt, speaking of which, on the other side of this break.
Tuesday morning. Welcome back to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla. We are live from Post 9, as always, at the New York Stock Exchange. David has the morning off. Take a look at stocks, starting off weaker and then coming up higher. We're about unchanged right now on the S&P 500. The NASDAQ is outperforming today. It's up about 1/3%, and the Dow's down 52 points, kind of waiting on some economic data. We'll get the biggie at the end of the week with the jobs report. Take a look at treasuries. As we kick off the month of June, we are seeing some buying today. Yields are a little bit lower, 4.426. We had a good Japanese bond auction. I know we're watching the global picture, and that may be having an impact here with yields softer across the board. Coming up this hour, we'll talk about it. Jefferies chief market strategist David Zervos joins us with his latest read on stocks and the macro setup as a key economic group cuts its forecast for U.S. growth. Plus, we'll talk to the CEO of Applied Digital. This is the AI data center company whose shares skyrocketed nearly 50% yesterday on news of a deal with CoreWeave in just a moment.
First, though, let's get some jolts and factory orders with Rick Santelli. Hey, Rick.
Hi, Carl. Indeed, on this jobs week, job opening labor turnover for April comes in at 7,391,000, above the 7.1 million estimates, and sequentially above slightly revised 7.2 million in the rearview mirror. That is the best since just February because we reversed that March downturn. Now let's look at factory orders. Minus 3.2 expected, minus 3.7 arrives, weakest since January of last year, and a negative revision from 4.3 to 3.4 for previous month. Take out transportation, still negative, but a bit less negative, down 0.5%. We're expecting a positive number, down 0.5%, weakest since May of 24. Now, these are durable goods coming up. These are final reads that replace mid-month read. Minus 6.3 remains at minus 6.3. That's the weakest going back to Jan of last year. If we look at durable goods ex transportation, a dramatic improvement, up 0.2 equals our last look, and that would be the best since it was up 0.4 in February of this year. If we look at capital good orders, non-defense ex proxy for capital spending, deteriorated by 0.2% from minus 1.3 to minus 1.5, making it the weakest going back to February of 23, Feb of 23. And finally, if we reverse from orders to shipments, it remains at minus 0.1%. Right now, we're looking at 392 in a 2-year, and after all the data, we oscillated a bit in terms of price, but we ended up at the same place. That is down 2 basis points. Long end down much more dramatically. Hence, we're looking at some steepening of the curve. 10 years at 441, down 6 basis points. Carl, back to you.
All right, Rick, thanks so much, Rick Santelli. Also new this morning from Atlanta Fed President Bostic talked to reporters a short time ago. He says, quote, pervasive uncertainty calls for a patient policy stance, but depending on how that uncertainty resolves, he says there is still space for one rate cut this year. Bostic also echoed comments from some of his colleagues that it's unclear if the tariff impact on inflation will be a one-time pass-through or something more permanent, which he says he's hearing from business contacts who are stuck in a wait-and-see mode. Also heard yesterday from Chicago Fed President Goolsbee, he's a voter this year, that the PCE data may have been, quote, the last vestige of the pre-tariff impact. But as for Bostic, Sarah, he says, quote, I am in no hurry to adjust our policy stance.
Yeah, not a voter this 2025 period, but this pretty much jives with what the Powell thinking and lines have been on policy right now, which is wait and see. They just don't see an urgency to cut interest rates because they're not seeing a significant weakening in the job market, and they're waiting to see if these tariffs are going to be inflationary. The good news is we've seen a lot of progress on the downside toward inflation heading into the tariffs. I mean, the last PCE report was very good news when it comes to progress on inflation. The question is, does that hold? You know, economy is very much in focus. Where are we? Remember I mentioned yesterday that all those recession calls were getting downgraded. Just wanted to bring a few key notes and what we're hearing today. So UBS actually said recession probabilities are moving back up, but they're still only at 37%. They're looking at some of the April data like durable goods and housing construction and saying that model has come up a little bit. OECD, you know, the big global think tank, came out today, cut the U.S. growth forecast because of tariffs to just 1.6% and 1.5% in 2026. Again, not recessionary, but they expect the growth to slow on economic uncertainty, a significant slowdown in net immigration, a sizable reduction in the federal workforce, all the stuff that we talk about every single day and what we hear about.
Yeah, I mean, 1.6, they were at 2.8 last year. And our friend David Rosenberg today argues if you're lowering this year and next, that somewhere in there implied is a recession. Of course,
Right.
David would go along with that view.
Which is 2 consecutive quarters negative growth. Look, you look at the where people are putting their money, and Kalshi is a good place to go, right, for the betting markets. It's been a pretty big swing. We've gone in just a month from 70% odds of recession to now 29% odds of recession this year. That's what's basically, go to the end of the chart and you can see that spike. That was, the April Liberation Day spike where it got as high as 69% odds of recession in the betting market. And look how far we've come down to 29% odds in the betting market. It's all about the de-escalation. I mean, right now, I think one of the reasons the market is flat is we're waiting to see when that call is between Xi and Trump. Remember, Eamon Javers, our reporter, suggested yesterday, he reported yesterday that that's going to happen soon. Those are the kind of headlines that move us away from recession. If we can get the trade deals and sort of eliminate some of the uncertainty that would cause businesses to not pull back and to do widespread layoffs. And so far, they have been waiting and seeing, just like the Fed. That's the kind of stuff that'll improve the outlook.
Right. Let's continue that conversation with Jefferies' chief market strategist, David Zervos. David, good to see you.
Good to see you, Carl.
I wonder how much weight you're putting on this phone call and whether or not that really gets the needle moving before we see some of that bleed through to hard data.
You know what, Carl? I think the needle is moving. It's been moving. This has been a tactical trade negotiation from the beginning. And I think where a lot of folks got twisted up is they took the opening gambit as a literal move and said, oh, this is where we're going to end up, which was really a worst case scenario. It was an attempt to drive people to the table in a negotiation, and the table is set. And we are seeing lots of folks from all over the world coming to that table and resetting the trade structure so that many of these imbalances that have been in place for decades get reset, much like they were reset in the 1980s during the Plaza Accord time in the mid-1980s, 1985, in fact. And that's kind of a narrative that we're using with our clients, that this is very similar to the trade negotiations that really centered more in the end on currency markets than they did on tariffs.
Right. But you're right. The market was sort of set up with a certain number of promises. Navarro, 90 deals in 90 days. I think it's been 52 days since he said that. I wonder whether or not you think there's a danger in some of these people across the table sort of rope-a-doping and slow going these talks.
Certainly. I mean, we saw the Europeans going slow. We saw the president push back. Then we saw them come back in, and everything seems to go back to a negotiation. I think we just have to look at this, Carl, as a storyline that is a negotiation tactic. This is how our president operates. It's different than past presidents. It's different than most past policymakers sitting in trade negotiation seats. But the idea is to end up in a fairer, more balanced trading environment. That's why I find all these forecasts, whether it's the Fed, the OECD, that are focusing on inflation or growth hits. Why? Why do that? This could end up actually very positive, and you should have that probability weight in your economic forecast just as well. I think it's a mistake by many to assume the worst, that everything goes to a less fair or less congruous trading environment. We could go we could go to a much more cooperative trading environment when all this is said and done. That's the goal.
I feel like that's what the equity market, David, is increasingly telling us. We're 3.5% off the highs on the S&P and 23% off the lows in the S&P. So at this point, it's kind of a glass half full approach. What needs to fall into place economically and from an earnings perspective to have that happen? Because there are still risks, right? As you change the cost structure of business, that there's going to be side effects.
Sure. And every one of these businesses is fantastic at risk managing. That's what they do for a living. These CEOs have many shocks, not just trade, but shocks all across their businesses to manage. And that's what they do for a living. That's why they get paid. And they'll continue to do that. Look, sir, we've got deregulation to get excited about. We've got a tax bill to get excited about, tax cut and job growth, tax changes that are going to be pretty significant. And we have a whole set of monetary policy changes that I think are going to be coming down the pike sooner rather than later that probably ease up financial conditions as we realize this was much more of a negotiating tactic and less inflationary than many people had thought. So there's just a lot of policy on the horizon that to me looks very positive for equities.
I mean, that was the view on the big, beautiful bill. You see that as stimulative? Because now there's a little bit of a debate about that and whether the market is excited about that, given bond market responses and concerns around deficit.
Absolutely. I think people got very nervous about that. They got nervous about the Moody's downgrade. We had a 10 basis point backup in 10-year yields on both announcements, or both sort of news hits, and within 24 hours that 10 basis points was completely unwound. These are not Liz Truss moments. These are not some sort of major bond market alarm bell. It's not an alarm bell that's ringing. This is a bond market that's actually, since the middle of April, since that crazy week in the middle of April, second week in particular, has been remarkably stable in and around the 4.5% area, which is where yields were on election day. Basically, they were 430 to 440. So we haven't seen that much movement in long-term interest rates for all the alarm and all the scare tactics that everybody's running around with. I don't think the market's buying it. And I think your point is very important, Sarah. The equity market is just not buying this doom type narrative that has been attempted to be sold to the body politic. It's not true.
Right. Although, I mean, U.S. stocks are underperforming the rest of the world by the most in 30 years.
Carl, yeah, you're absolutely right. We're coming off an incredible run of what we all call somewhat of the exceptionalism trade of the last 5, 10, 15, 20 years. It's been a heck of a run. And people are protecting themselves. I think they see, Carl, a reason why there may be a recalibration of the dollar. And that may be part of the trade negotiation, like what we saw with the Taiwan dollar not too long ago, which I do believe is part of their negotiation tactic on trade with the administration. And part of a recalibration would be a more competitive dollar. I don't like to say a weaker dollar. I like to say a more competitive dollar. And I think that people are looking at that and going, well, maybe I can park myself outside of the dollar a little bit to hedge for that. I actually think it's a great story long term for U.S. stocks to be more competitive. I do think you want to hedge out the dollar a little bit here. And I do think we are going into a period of dollar weakness. But that actually is a huge long run positive for U.S. equities because it just makes our companies that much more competitive.
If there's not a loss of confidence. Right. Yeah.
Can I get you, David, before we lose you, this Section 899 of the bill gets written up in the FT. I know PIMCO wrote about it the other day, this revenge tax. They call it the sledgehammer, which would require Treasury to report to Congress every 3 months about punitive policies around the rest of the world. And then with the option to get even, in a sense. I wonder if you think that's going to be a suppressant on foreign capital.
I really don't. I think this administration is welcoming foreign capital. You saw the president in Pennsylvania welcoming the Nippon Steel deal with U.S. Steel. I mean, if there's anything this administration seems to want, it wants to bring in capital. It wants to see capital flows coming into the U.S., job creation in the U.S. I just don't buy that as a sort of tactic that this administration is going to use. I think more than likely they're going to be upset if they see jobs going because capital is leaving the United States for Mexico, Canada, or any other country. And so I just don't buy the attack on foreign capital. I think, look, there's an initial part of this currency revaluation trade that I'm thinking about that says you have to be careful. You don't want to be there for the beginning of it. You gotta hedge it, which you can hedge, and it's the most hedgeable thing in the world. You can just hedge the currency on anything. But when you get to the weaker currency / more competitive currency situation, U.S. companies are going to look incredibly competitive relative to their foreign counterparts, and capital is going to flow back to the U.S. because it's going to be that much cheaper. Imagine if the euro was at 140. How attractive would the U.S. investments look?
Well, look what happened with Japan. I mean, the Nikkei was the hottest trade in town on the weekend.
Well, yeah, absolutely. And by the way, do you remember back in 2013 and 14 when the Japanese were devaluing the yen and the Europeans were devaluing the euro and they were getting excited about QE? Everybody was piling into European and Japanese stocks, but they were hedging the currency, Sarah. They were using those ETFs that said, buy the stock market, but hedge back to dollars. In many ways, I think that's the trade here in the U.S. Buy the stocks, but hedge the dollar a little bit.
David, I'm glad we have you to help us give us a gut check on a lot of the torrent of the negative news headlines that we get every day. Good to see you.
Always a pleasure.
David Zervos.
Here's our roadmap for you for the rest of the hour. Meta making waves in the nuclear space today, teaming up with Constellation on a big power deal. But names in the space are pairing gains. We're going to break it all down for you next.
Talk to the CEO of AI data center company Applied Digital, up 50% this week on news of a deal with CoreWeave.
And Goldman Sachs' head of investment grade credit here to tell us whether he sees merit in Jamie Dimon's warning for the bond market. Big show still ahead. Squawk on the Street will be right back. Technology helping the S&P recover to the highs of the morning. We'll be right back.
Kitsch.com.
Meta is inking this new power agreement with nuclear player Constellation Energy, initially giving a big boost to nuclear stocks, although some have pared their gains. Our Pippa Stevens joins us one details. This is pretty interesting on both parts.
Yeah, Carl. So Meta is getting in on the AI nuclear race, signing a deal to buy all of the power generated from Constellation's nuclear reactor at the Clinton Clean Energy Center in Illinois. The plant had been in danger of closing, but this 20-year deal gives Constellation the certainty and the money to invest in the plant and even possibly add another reactor. This nuclear plant is not going to power a Meta data center directly. Instead, it will continue to power the regional grid while helping Meta reach its goal of 100% clean electricity. This is just the latest instance of big tech teaming up with nuclear. Driving these deals is AI's insatiable need for power. Alphabet and Amazon are backing small modular reactors, while Microsoft signed an agreement last year to restart 3 Mile Island. Today marks Meta's first nuclear deal, but it likely won't be the last. In December, the company said it's looking for partners to add as much as 4 gigawatts of new nuclear to the power grid, guys.
Some reports indicated this center might have closed had it not been for the deal. Is that true?
Yeah, that's right. So starting in 2017, it was at risk of closing. And so then Illinois implemented a zero emissions credit that it's been relying on. That expires in 2027. And so this deal from Meta, which begins in 2027, is effectively taking the place of that. And had Constellation not had that 20-year certainty, it might have been closed. And also, in some respects, this is even better than a state credit because it is longer term. State and federal credits don't necessarily carry over,
Right.
and this is 20 years of firm commitment.
Okay, Pippa, thank you. So look for more deals like this, I guess.
I think so.
All right. Feels like a regular occurrence. Pippa Stevens. Another AI deal news, CoreWeave announcing a pair of lease agreements with data center company Applied Digital yesterday, which sent shares of Applied Digital, APLD, up nearly 50% by Monday's close. Joining us exclusively is Applied Digital CEO Wes Cummins. Wes, it's good to have you. You know, stock market analysts see this as a narrative-changing event for you. Is that true?
Yeah, I think it is. It's really the culmination of the hard work that we've been doing over the past 2 years, where we started building this building in Ellendale, North Dakota, really a purpose-built building for NVIDIA infrastructure, really around GPUs, and then signing this lease for the first 2 buildings it's a great event for us, but it's just the start for this campus and for all of the capacity that we expect to build in the Dakotas region.
When do you expect it to actually start adding revenue, and what does that look like?
So the first building, which is 100 megawatts of critical IT load, should start adding revenue in Q4 of this year. And then the second building around the end of Q2, calendar Q2 of next year.
Is there demand outside of CoreWeave? Could you do these type of deals with others?
Yeah, it's a great question. We've had a lot of interest from, we typically focus on hyperscalers. For these size of campuses that our company is building, it's really designed for, just a handful of companies in the world, CoreWeave being one of them, but the other hyperscalers. And we've had significant interest from many of the hyperscalers, almost all actually in the region, given the low power cost profile, given the PUE, which really relates into efficiency of the facilities, given the cold weather there. And there's an abundance of renewable energy in the Dakotas, especially in North Dakota, and that's what we're capitalizing on, and that's what we're seeing a lot of interest from, like I said, not just CoreWeave, but a lot of the hyperscalers.
Wes, I noted that some of your earlier efforts might have been more Bitcoin mining heavy, and then you sort of shifted into AI as that picture became more obvious. I wonder, where does it leave sort of the crypto AI balance right now?
Yeah, so for us, Carl, it's a great question. For us, we started by building large-scale Bitcoin data centers. We never mined Bitcoin ourselves, but we hosted customers for mining Bitcoin. And then we moved on in 2022. We started building designing high-performance computing facilities. They both use immense amounts of compute and large amounts of power, and they both require a lot of cooling. But HPC is a very different build versus so the AI builds are very different versus Bitcoin. So it took us a lot of iterations to get it right and get it right on the building that we did now. But we're really leaning hard on the high performance computing AI builds for the future. Bitcoin will still be a meaningful part of our business, and actually it pairs really well at the individual sites where Bitcoin is much more interruptible power. And so if you're not using all of the power you need for your HPC facilities, or for our HPC facilities, we can actually just run that for our Bitcoin data centers for our customers that are mining Bitcoin.
Have there been like big advances in cooling technology, or are there some that are still over the horizon?
So the biggest thing, one of the biggest things I think is going to happen this year is we're doing large scale liquid cooled deployments at scale. So our building, this first one that'll turn on in the October timeframe of this year, this is 100 megawatts critical IT load. It's direct to chip liquid cooling, expected to be Blackwell class servers going into the facility. So that's going to be a big thing for this year. And then, out on the horizon, I think liquid cooled direct to chip is going to stay around for a long time. There's a lot of things on immersion cooling that are being worked on. I don't see that at scale in the next few years, but that would be the next thing on the horizon.
So how is your capability on inference specifically as we move from machine learning to inference? And what does that say about demand? Because CoreWave's moving, all the hyperscalers are moving in that direction as well.
Yeah, so you're going to see inference growing really fast. I think you continue to see training grow, but inference is going to grow much faster. And so facilities like ours, you've seen data centers move to the middle of the country. So you see Google with a big deployment in Omaha, Microsoft in Des Moines. You've seen a lot of movement away from the coast and into the middle of the country because that's where the power is. And our facility has, low latency, less than sub 10 millisecond latency to some of those regions. And so it can be used dual purpose for training and for most inference applications, not all, not ultra low latency real time applications, but a large amount. But going back on the inference, I mean, you're seeing just the usage growth massively. If you look just at ChatGPT, you're seeing it go over 1 billion queries a day here in May. That's 2.5 years from launch to 1 billion queries a day. So you're seeing the usage go up, which is inference. They're continuing though to train. GPT-4 came out earlier this year, GPT-5 later this year. So the training is going to continue to grow, get more difficult. So we expect demand there, but inference is rising rapidly. I mean, that billion queries per day, it took Google 11 years to get to 1 billion queries a day from launch, and ChatGPT did it in 2.5 years. So you're just seeing this massive uptake.
And just, finally, Wes, on the stock, I mean, clearly great day that you had. The stock doubled, but it's like less than 3 times less than what it was in 2021, and it's kind of been hovering. What do you have to do to change the thinking and make it sort of the next AI hot data center play? And what's been the concern?
Yeah, I think signing this lease was a big event for us as far as what it means for our shareholders and our company. So we started building this campus on spec without a customer back in 2023. We thought we had the right design. We thought we had the right idea of kind of meeting the future where, for the future demand, what would be needed. And so now that's proven out with this lease signature. And what we need to do is execute, turn on these facilities. We put out that these 2 buildings by themselves will generate north of $300 million of net operating income for our company, or NOI, once they're fully online. So basically about this time next year. And then really it's executing. This is, just the start for our company. We have over 2 gigawatts of power in the region. And so this is 250 megawatts. This is, a little over 10% of the power that we have in the region. And we're just going to continue to execute and build these buildings and, hopefully sign new customers. And I think that's how we create value for our shareholders.
Are you in talks with it? You mentioned hyperscalers, Amazon or anybody else? I think the market would have been even happier to see that.
Yeah, look, CoreWeave's, is a fantastic company. We're really excited to work with them. We think they're really ahead of a lot of people on where the cloud business is going. This high power density GPU, they have a purpose-built cloud, so we're really excited to work with them. But we talked to all of the hyperscalers that you could think of off the top of your head, and we continue to talk with them about the capacity that we expect to bring on next year and in 27, 28, and all the way through 2030.
All right, well, keep us posted on those discussions, I guess. Wes, thank you very much for joining us on this deal.
Thanks for having me. Thanks.
Wes Cummins, Applied Digital CEO.
Still ahead this morning, the man in charge of corporate credit over at Goldman, advising America's biggest companies on their multi-billion-dollar financings. Johnny Fine is going to join us right here at Post 9. Plus, some strong results from the high end and the low end. We'll break down some new numbers boosting both Dollar General and Signet after this.
We are 30 minutes into the hour. Here are three big movers we're watching. Joby Aviation jumping after a report said that the company is working on a deal with a Saudi Arabian investor for as many as 200 air taxis. It's up 9%. Dollar General pacing for its best day ever now after topping Wall Street estimates for the first quarter, also raising its annual sales outlook, though the company did say tariff uncertainty remains a wild card. And then Signet Jewelers also getting a nice lift today after a beat and raise quarter. The company's new CEO telling me its three largest brands, Kay, Zales, Jared Jewelers, all saw comp sales improvement over the fourth quarter, also saying the team has taken action since April to minimize the cost impact of tariffs, adding, quote, "We believe we can navigate tariffs as they stand today within our full year guidance," offering some reassurance there. If you can keep guidance as a retailer with the tariffs as they stand, stock up 12.5%.
Let's get a news update as well with our Silvana Hanal. Hi, Silvana.
Hey, Carl, good morning. A delegation of senior Ukrainian officials is in the nation's capital today following yesterday's direct peace talks with Russia in Istanbul. An aide to President Volodymyr Zelensky says the team will speak with Democrats, Republicans, and President Trump's team to discuss defense support and strengthening sanctions against Russia. Closing arguments are expected to begin soon in Harvey Weinstein's second sex crimes trial. A jury found the disgraced movie producer guilty of rape 5 years ago, but New York's top court overturned the conviction on an appeal, citing issues with the court proceedings. In the current trial, Weinstein faces allegations he attacked 3 women in Manhattan between 2006 and 2013. And Alaska Airlines announced today it will make its debut in Europe next year with nonstop service from Seattle to Rome. The carrier's new route comes after it acquired Hawaiian Airlines and its fleet of long-haul jets last year. The 4 times a week service will begin next May and will go on sale in the coming fall, Sarah.
Okay, Silvana, thank you. Coming up, Jamie Dimon warning about a looming dislocation in the bond market. We're going to discuss with Goldman Sachs' credit expert Johnny Fine next. Plus, Tesla competitor and Chinese automaker NIO, the latest EV name to disappoint the street. A read on some new numbers there, what it means for Tesla shareholders when we come back.
Come on!
Welcome back. JP Morgan's Jamie Dimon making headlines after comments to our Morgan Brennan about a looming crisis in the bond market. Take a listen.
You are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money, and then some of my friends will tell me that we like crises because it's good for J.P. Morgan Chase. Not really.
Is that concern justified? Our next guest is in charge of corporate credit at Goldman Sachs, advising America's biggest companies on their multi-billion-dollar financings. Johnny Fine, Goldman Sachs Global Head of Investment Grade Credit, joins us. Welcome back. It's good to have you.
Thank you. Great to be on with you again.
So, I mean, we all know there's going to be a reckoning in the bond market at some point. The question is he right to raise the alarm now?
So I agree with the general thrust of what Jamie's saying. I agreed with what our president and COO, John Waldron, said last week, in that the deficit was a bigger issue for markets than tariffs were, and that there was going to be at some point a dislocation in the bond market, probably in the long end. I agreed with David Solomon, our CEO, at the beginning of the year when he said that we need to be super focused on deficit, debt, and overall financing of Treasury. But this isn't a new story. This has been something that has ebbed and flowed for a really, really long time. In fact, coming out of the financial crisis, then President Barack Obama in 2010, he set up a commission to look at fiscal reform. And at that very first meeting, then Fed President Ben Bernanke talked about how we would need to have meaningful fiscal policy reform at the government level if we were to have any hope of lessening our deficits.
It's the Simpson-Bowles, right?
Correct.
Yeah.
So for 15 years, we've been talking about it. It's been ebbing and flowing.
But are we reaching that moment?
We're certainly flowing more readily in terms of it being very topical for the markets and it creating certainly term premium in bond markets overall. And I don't know if ultimately we'll reach a tipping point in the next 5 years. I don't think it's going to be in the next 12 months, but it will happen at some point or another. We should be focused on it because even when you look at term premiums today reflecting this, there's 75 basis points of incremental yield embedded in 10-year yields. That gets passed on in the form of mortgage rates being 75 basis points higher than they otherwise would be. It gets passed on in corporate issuance rates being 75 basis points higher than they otherwise would be. It's a real tax on the economy.
So we're starting to feel it, you're saying. We're just not at a crisis moment.
We're starting to feel it. I don't think we're in a crisis moment as it stands right now. Really, the fiscal balances as they stand today is a continuation of what we've had over the last several years. It's not got any better. It's not really got any worse either. It's going along the same path.
I mean, it's only a problem, though, Johnny, right? If people don't want to buy our bonds, it's a demand problem. Is there any sign of that? Any sign of foreigners, for instance, or any buyer strike?
No, I don't think so. If you look at the foreign holdings of US Treasuries as they stand today, they get reported weekly, kind of unchanged over the course of the last kind of couple of months or so. And so even with the theme of the waning of American exceptionalism, we've seen how that's played out. It's a weaker dollar, it's higher Treasury yields, it's higher gold and cryptocurrency prices overall. I don't think there's liquidation of dollar assets. I think marginal dollars, as they get recycled into financial assets, I think they're looking for other homes. And that's creating, I think, a bigger uplift to international equities. And it's actually led to a pretty interesting broadening of international capital markets activity outside the US as well.
And you think that trend continues?
I do. If you kind of think about in the world that I traffic in and day out in global financing markets, the two biggest markets are the dollar markets and the euro markets. Traditionally, the split between financing volumes is around 70% in dollars and 30% in euros. Since April 1, where we really, I think, mark the end of the American exceptionalism trend, that's been more like 60-40. We just finished the busiest ever non-financial corporate issuance month in euros. We're seeing a lot of US issuers finance in the euro markets. There's real demand dynamics, I think, driving European fixed income markets as capital allocations flow into non-dollar opportunities. And also with a 200 basis point or so yield differential between 10-year dollar rates and 10-year euro rates, companies in the US are very much incentivized to try and finance their international operations at a lower yield.
Do you think Lagarde then is wise to sort of take this moment and try to light a fire among the EU, and with some pretty aspirational goals, if in fact they think the euro can be competitive as a global reserve currency, right?
Yeah, so I don't think we're going to see the loss of status of the dollar as the world's reserve currency. We might. I really don't think that's likely to be the case. But the euro is now a more competitive economic bloc. There's a more competitive economy that will go through similar fiscal impulses to the positive with the defense spending, and will go through similar deregulation as well. I think it's a more attractive place for people to think about putting their money.
That's a far cry from Davos even. That was
100%.
5 months ago.
Yeah,
right.
Things are changing quickly.
All right, well, Johnny, thank you for coming on, giving us all the color from
Always
the
a
bond
pleasure to
desk.
see you.
Johnny Fine from Goldman Sachs.
Thanks for having me.
Still ahead this morning, the growing arms race in autonomous driving as Tesla and Google's Waymo jockey to be the first to hit the mainstream adoption status. Who is taking the lead, and what does it mean for both shares in a moment? Also, watch shares of Hims and Hers today, adding to some gains on the year after this new acquisition of a European platform. Details on that in just a moment.
That's 2020. There's certainly something going to happen in 2027, and I don't know what it is.
Okay.
I've also heard 2034, and I've also heard other dates, much later. But depends who you talk to. Some people say it's a pole reversal. Some people say it's an asteroid hitting the planet. Some people say it's AI reaching quantum, and then all of a sudden we lose the capacity to have control of our own computer systems. I have no idea. What I am aware of is that everybody's telling me we're on borrowed time. And I cannot begin to emphasize how serious a look I get when I say to people who are confiding in me, what's the timescale on this? And they're urging me to be urgent. They're saying to me, people need the right to know this. They have a right to know this. And I'm going, well, what are we talking about? And I feel like shaking these people and saying, for God's sake, just bloody tell me. And they are all constrained by their national security oaths. They want the public to know this.
Number of headlines around the auto sector today. Ford reporting a 16% increase in May sales driven by pickups and crossover SUVs, though sales of all electric vehicles fell. Meantime, NIO posting a wider than expected Q1 loss as competition puts pressure on the Chinese EV maker's profit. Also announcing it will expand its rollout into Europe, posing another threat to Tesla as it struggles to regain ground there, ex-Norway. And then Truist calling Waymo a hidden gem for Alphabet as the street finds value in self-driving. This as Tesla looks to launch robotaxi next week. So now it's kind of a race with both of them. We'll see if Waymo has that first mover advantage.
Let's talk more about the automakers with DVX Ventures co-founder and partner Kareem Bousta. Kareem oversaw the worldwide services and customer experience segment at Tesla and ran operations at Lyft. Kareem, thanks for being with us. Good to see you.
Good morning. Thanks for having me.
Really interesting race we've got set up. Sarah mentioned sort of the head start that Waymo has, but there's a lot on the line for Tesla next week. How much do you think this different strategy on technology can help them catch up, if at all?
Well, I think we have to look at what is going to happen in the next few weeks with the lens of understanding two things. One is the pilot that Tesla is launching next week is likely to be very small in nature, very low scale, and frankly, very, very likely to succeed. because we're talking of a limited pilot, limited scope in defined neighborhoods with a lot of constraints that are put into the system. So it's very feasible with the technology and the level that Tesla has achieved to be able to give a few hundred rides per week in a safe and reliable way. The real proof for Tesla will be to see how fast they're able to ramp this and if they're on a pace, on a path to be able to catch up to Waymo. For comparison, Waymo is currently giving 250,000 rides every week in fully autonomous robotaxis. So the question is, it's not whether Tesla will be able to launch next week with a limited size pilot, but whether they'll be able to catch up and put themselves on a trajectory where they can catch up to the hundreds of thousands of rides per week that Waymo is currently doing.
Right. So what's more important, sort of being aggressive and narrowing the spread, or doing no harm, as you seem to suggest?
I think the most important, and Elon alluded for Tesla, Elon alluded to it a few weeks ago, is to bring the service in a safe and reliable way. Because at the second you lose the trust of the consumers and the regulators, you put the whole program at risk. So safety and reliability are going to be key, even if it means going slower, which means longer time for Tesla to catch up.
Have you been impressed with the degree to which Waymo has taken share, even in certain markets like San Francisco?
Yeah, I must say this has been very impressive for me. I've been I used to be in the Silicon Valley in California and San Francisco, seeing from the early days, 7 or 8 years ago, the beginning of the Waymo journey, and seeing how quickly they've been able to solve self-driving at scale, and now bring it up into a service that is reliable, that is safe, that customers enjoy is really impressive. And I think they have another advantage compared to Tesla, and that's the partnership they've entered with Uber in the new markets like Austin and Atlanta. That gives them, we see that this gives them an ability to accelerate the adoption. And it's a very powerful partnership with Uber, bringing the operational excellence at scale, the knowledge and the expertise for how to run this type of operations, and their decade of experience with the technology and the self-driving technology that Waymo is bringing. So very impressed and very confident about Waymo's ability to continue on that path.
So beyond the robo-taxi event and catalyst on Tesla, we're keeping track of these European auto sales, which just continue to fall double digits. And the NIO announcement that I just said that they're going to be expanding further into Europe, how big of a threat is that?
I think this continues. It confirms what we've seen for a few years, where Tesla is no longer leading the way in terms of EVs. A lot of people are catching up. New players, new entrants, creating really great products that customers love. And also, frankly, the traditional automakers also catching up with very good products and very good infrastructure. Because you always have to remember, to succeed with EVs, you have to create a great product, but also help customers with the change in the ownership experience, with a charging infrastructure, giving them access to all the things they need to enjoy driving an EV every day. And I feel automakers like NIO and others in China, but also traditional automakers, have definitely caught up. And that confirms the big threat that is on Tesla, on their leadership, that they're losing in many markets.
I mean, you were part of that leadership for a few years until 2018. What can you tell us about that experience? First of all, why'd you leave? And what can you tell us about the culture there now that they're, playing from a place where European sales are falling and they have competition on robo-taxi, and how Elon's going to approach all that stuff?
Yeah, I think that at the time it was a different time. We still had to prove that EVs were going to be a thing, that the EVs were going to be successful. It was all about the obsession for creating that perfect product and that perfect experience for the customer. And that's really what allowed Tesla to win at this time. Convince customers that owning an EV, owning a Tesla was a great thing to have, and then creating an enjoyable experience. And then putting all that obsession on the customer experience at the service of building great processes, great teams that were able to scale the company very, very quickly. To your question about why I left, I reached a point in 2018 when we had achieved what we wanted to achieve in terms of showing that Tesla was going to be able to succeed. We had achieved what we call the mass level in terms of production and sales. And it was time for me to look for another adventure and something else to do.
Well, a lot of eyes going to be on Tesla next week, and this race is really interesting and probably in the end pretty beneficial for consumers overall. Kareem, appreciate your help helping us understand it. Talk soon.
Thank you. Thank you. Thanks for having me.
Shares of Hims and Hers Health doubling on the year, adding to gains this morning on a new acquisition abroad. We've got the latest for you on that next. And as we had to break, check out Broadcom, just hitting a record intraday high. It's first since December 2024. The company reports earnings Thursday after the bell, and we are seeing strength in that name. Also, NVIDIA at the top of the list today, along with Tesla and Amazon, all helping the tech trade fuel the overall S&P and NASDAQ. We'll be right back.
Happy with it.
Welcome back. Shares of Hims and Hers Health on the move this morning on some M&A headlines. Brandon Gomez spoke with the company CEO, joins us with some of the details on this sort of battleground stock. Brandon?
Yeah, and a shorted stock, too, we have to note as well. But look, shares off their morning highs. Initially on news, it will acquire a European telehealth platform called Zava. Now, Hims CEO telling me on a call over the weekend, we're excited to accelerate both the European expansion, but also use this platform, Zava, as an accelerant to move into new markets. Now, the company did tease plans for global expansion plans during the company's first quarter report, recently bringing on a new chief operations officer, Amazon veteran Nader Kabani. But this isn't their first toe dipped into international waters either. The company has been in the UK since 2021. This deal expands Hims' reach to Ireland, Germany, and France. Hims already has 2.4 million subscribers on its platform. Zava expands the company's reach with 1.3 million active customers as of last year. Now, I did ask the CEOs if they expect any regulatory hurdles given the fact that this is the EU. Hims said this is a pretty straightforward deal. That said, we know the EU tends to have a more scrupulous review process, so possible headwind there. there. But when you look at compounding in the EU, similar allowances for what's allowed here in terms of personalized medications. Think about the market for those compounded GLP-1 drugs we talk about. HIM CEO also mentioned the pricing of pharmaceuticals being much more consumer advantageous in broader Europe relative to the US, but there's been a growing demand for telehealth with the strained public healthcare system there struggling to meet demand. The deal is expected to close by the middle of this year, which the company said is when we'll get details regarding the terms of the deal, pricing, things like that.
Right, not disclosed today.
Right.
Brandon, thanks. A pretty interesting deal watching Europe. After the break, a fresh read on the health of housing from one of the country's biggest home builders, the CEO of TriPoint Homes. He'll join us as we've just reclaimed 5950. Money Movers begins after this.
NBC.
Oh my God.
a reality.
NBC is America's premier crypto platform. Pumpkin.care.